All right. So sorry, everybody. So we're gonna go ahead now with chapter 13. That is health chapter, life and health. We're going to talk about health insurance, accident and health insurance. It's a very sweet chapter, but however, it's very boring. So we're gonna enjoy it. We ask questions. Remember, for the new people who are here, here is interactive. It's just interactive section. It's not really, I'm just moderating. So we're gonna put it together, discuss what we need to know to pass our exam. The priority here is to pass the exam. So in as much as we are trying to give them a little bit leeway of how to start the business on your own, but we still have to talk about the passing the exam, which is the most important thing why everybody's here. So we're on a discussion section. Please bring in your own idea. Let's talk it. Let's make it a way. Let's make it more interactive. All right. We have been able to go through all this yesterday. We're going to start from where we stopped. We were able to go through all this yesterday. All right. Let's start with medical. We start from 2.2, which is medical expense insurance. Medical expense insurance. Just like we said on the introductory remark, we talk about at your work, they give you life insurance and group life insurance. And on the health insurance aspect of it, is an issue that everybody should be aware of. Even if you're not at work, most people are obliged to get health insurance because it takes care of you, it reimburses you. And in health insurance, the way we take it is not actually how it is as regards to life insurance. Life insurance, the insurance company takes the risk. So health insurance, you're part of the risk. But in life insurance, you transfer all your risk to the insurance company. So you can see that, but in health insurance, the risk is somehow mutually shared. So that's why we talk about in the payment terms, money is involved, most especially in life insurance. That's why the risk, transferring the risk to them means that you're paying premium. And what is that premium? The money you are paying is the premium you are paying to buy that amount of, to transfer the risk to them. The insurance company say, oh, come, give me pay me so amount, and I will take care of your risk. You carry all the risk and give them, and they say, all right, this risk, I'll keep it and manage it for you. You pay me your premium, which that premium will be 200, 300, depending on how much a policy you buy. That is quite different from what we are seeing in health insurance. So today, let's go into medical expense insurance, which provide coverage for the cost of medical care. I think it's like we jumped something. It's like we jumped something. Let me see. Oh, no. I think we're fine. All right. So we're on the medical expense insurance. It's a coverage cost for medical care. Coverage cost for medical care. For instance, in the exam, definitely, most often, we're going to rush through this chapter. We'll go to the most important thing that you can see in the exam. Most important thing you can see in the exam. This chapter is boring, as you can see. It's very, very boring. But we still have to pay attention to it and get the fact we need to pass the exam. So medical expense insurance provides coverage for the cost of medical care by reimbursing the insured, either fully or partially. So you have medical expense insurance. What they do, the cost of care is you reimburse the cost of care. Of course, they may not reimburse it to you, reimburse it to the provider. The provider, you go to the hospital, the hospital take care of you, or you go to the clinic take care of you. The insurance reimburses them for the care they provided to you. So these contracts are a form of reimbursement insurance that covers one or more types of loss. Remember yesterday we said what causes loss is peril. Peril causes a loss. So we use issue of car insurance to give example of peril and the loss. So it's often challenging to assess relative importance of different types of insurance. However, we should also remember that if we consider that a health insurance program should begin with sufficient medical expense insurance. So medical expense insurance is most important one. That is where health insurance starts. Of course, life insurance starts from your paying premium. If you do not pay premium, you don't get nothing. So in health insurance, if there's no medical expense insurance, you do not get health insurance. So currently, most Americans have coverage through a major medical policy or service plan, the HMO. This issue of HMO is what all of us should know today. HMO, PPO, all those, why are they on board? Why do they come in? If we actually have Medicare as the topmost, why do we now have HMO and PPO? That's one question everybody should ask. In Medicare, we have Part A, Part B, Part D, and Part C. Why do we have Part C? Part D is understandable. On Part D is for prescription drug. Then why do we have Part C? They say Part C is for something that Part A and Part B cannot do. Then what is that Part A and Part B cannot do that come over to Part C? Then in Part C again, Part C say he cannot take it over, or Part C introduce HMO and PPO. So you see how the little money you have on the insurance is being distributed. By the time you get to the final provider who provides care, then you have little or no more to get. So we are going to see all of them step by step. So let's look at this. For example, it's a medical plan with $500 individual deductible will cost more than comparable coverage with $2,500 individual deductible. The policy with a 80-20 co-insurance. You see this 80-20 co-insurance, for instance, even the one they give you a job, try to find out what is the copay, what rate the copay, how many percentage copay, how many are you contributing, and how much the insurance your company is contributing. Because most often we don't know whether it's contributory or not, whether the company, how much are they contributing. That will even help us in accepting the job offer. If you have two places you had a job offer, you have to find out what are they contributing, how much, how many percentage. Even on the group life insurance, this is exactly what you have to find out. Because in a group life insurance, they give you a simple term, which is level term. Then you get a job, they say, oh, then I'm going to give you a group life insurance. How many percentage are they contributory? If it is contributory, if it is not contributory, if there's no contributory, you can as well go and buy your own term life insurance. But if it is contributory, ask them how much are they contributing to it. If you compare two companies, one say I'm contributing 75%, the other one say, oh, I'm contributing 65%. You can see if you want to take the job based on the or based on what they're offering to you in terms of their health insurance. For people who take job because of benefits. So if you are taking a job based on benefit, you should be able to define actually what are you getting out of it. So you have two companies who offer you job. All of them are giving you benefit. They are equally giving you health insurance benefit, life and health insurance benefit. Ask them, is this contributory? They say, yes, it's contributory. How many percentage are you guys contributing? This one say I'm contributing 75. This one say I'm contributing 65 or 50 or 65 or 50%. So by the time you compare the two, you'll be able to know which one you take, because you already know they are contributing 75% to my life insurance. They are contributing 70% to my health insurance. So that will help you to determine which of the company you will take. Because if the company is not contributing, most especially in group life insurance, if it is not contributory, there's no basis. Of course, you as a own can go on and buy term life insurance. That's just the thing. That is the only difference thereof. I said it yesterday. When you own your own buy term life insurance, you have limited time to convert. If you want to convert to whole life insurance with cash value, you have a limited time. Some insurance company will say 3 years, some insurance company will say 5 years. But if you have your term life insurance, which is the group life insurance we have at work, it gives you the opportunity to convert at any time you're out of that job. So that is one of the advantages we have. But if not, if the company is not contributory, they're not contributing to it, honestly, basically, there's no need. There's no need. You can as well buy a term life insurance by yourself. So a policy with an 80-20 co-insurance provision will cost more than a similar plan with a 75-25 co-insurance provision. So you see, 80-20, this is co-insurance, and 75-25. Probably the company is contributing 80%, and you as an employee is contributing 20%. Then this one, the company is contributing 75%. You as a employee is contributing 25%. You can see at these two, if you compare these two, you will see that you as a person will go for the one that is cheaper for you. This one is contributing, let's contributing 80%, and you are contributing 20%. This one, company is contributing 25%, and you are contributing 25%. Why wouldn't you go to the one that the company is contributing 80%, and you are contributing 20%, which is less money is taken from your paycheck every month, every paycheck. So everybody will rush to this because it will be cheaper for you. So these are the things you have to consider. Most often, we are so carried away by the word. We are giving you benefits. The minute we hear the word benefit, we don't even want to know. We just zoom into it without knowing what is inside that benefit. So, disability insurance. Another thing most people do, which I did it before, I did it when I didn't know when I did it, disability insurance. If you are giving group life insurance in your job, it's your own, you have the chance, the opportunity to log in and check what you have. Remember, in group life insurance, you as the employee supposed to have the certificate, while the insurer, the company, the employer has the master contract. That's what the law says. But because they do not issue us, the employee, the certificate of insurance, we do not know actually what is inside that policy. You only log in and see things, and when you go to the system, you see things, what you have, which may not give you a clear view of what the company says about the policy you have. But if certificate of insurance is given to you, that will actually detail all that you have. Yes. So when I had my own, I did not know at the point of signing it, the renewal they normally do every year. Companies normally do. I've forgotten what they call it. The one companies normally do every year, they say you sign in for another year. So I didn't know I have disability insurance. It's so good, it's so wonderful. I didn't know until when I retired from my job. I said, all right. When they gave me all the details, I now find out that I have disability insurance. So this is another kind of insurance that anybody can have. So effective financial planning must include the risk of income disability. Income disability. When they call it disability insurance, equally protect your income. In case if anything happens, you couldn't be able to work. You couldn't be able to do anything. You couldn't be able to do any income as you normally. You can file a claim. Not when you are healthy. Not when you are maybe just like as I retired, I have disability insurance. I go and file claim to get my disability income. No. When you are working, you couldn't be able to work again due to one sickness or another, or due to any accident, due to anything that can prevent you from getting your income. You can file a disability insurance. What that does is to provide you the income you normally make when you are still working. So disability insurance is one of the things that is so good. People should go for it. We are restricted because of the finance, but if not, honestly, the best thing to do is to put everything about you, put it in insurance and get rest. I'm telling you, if it's possible. Like I say, if it's possible for me, I will insure everything. Everything. Give it to them, let them manage the risk so I'll be free. So disability insurance, also known as income replacement insurance. Income replacement insurance, also called disability insurance. It replaces your income if you could not be able to do anything due to illness or injury. That's what it does. So income replacement insurance or disability insurance cover the loss of one's ability to earn income due to illness or injury. So just like I have my own, I cannot just file claim because I have disability insurance. No, I will only file claim if I cannot have the ability to earn an income due to illness or injury. That is when I file for disability insurance. If a disability claim, if not, you only pay. Like me, I pay my every month. I pay the cost every month. So if you have it, it's good. If you're sick or you are injured, you file for claim. They will replace your income. They will be giving you your income of which you are earning before the sickness comes. So the income replacement insurance, which is also called disability insurance, provide guarantee weekly or monthly payment when wages are lost. So imagine somebody making 1,000, or maybe let's assume 2,500 or 3,000 weekly, or 3,000 or 4,000 weekly. Then you are sick or injured, you have disability insurance. If you file for it because you could not be able to work, definitely it's an income replacement. They will be giving you that money you're making as it is. Either you are paying you weekly, they will pay you weekly, or if your company is paying you by weekly, they will. If it's monthly, they will be paying you that. So it replaces your income. It's a good policy to have. It's a very, very good policy to have for anybody who have the ability, more especially when you're at work. Now, for people that are still working, log into your own. When this enrollment period, just check it and see whether you have it. If you don't have it, it's good to have. However, remember that when you take it that you're now taking disability insurance, it's going to affect your paycheck. It will, because what you are getting may have a small reduction. But believe me, you may not pay much. But what I'm paying on my own is, I think, $78. $78 every time from my paycheck. That's the one that's going to my disability insurance. And now that I retire, I have continued to pay the disability insurance because I converted it to individual disability insurance. So many individuals mistakenly rely on Social Security to replace their income in case of disability. That is a mistake, all of us in the community. That is a mistake we make. In fact, everybody so much believes in Social Security. Everybody, excuse me, let me go. Sorry. So everybody so much believes in Social Security. That is our greatest undoing. You see some of our brothers and sisters on the street, you want to talk to them, the first thing they will do, I got it all. They got nothing. If you bring them down, sit them down, and educate them, you see that they are just as empty as every other thing. They have Social Security. Another great thing they have also, they have their 401k, not knowing things surrounding those things. So many individuals mistakenly rely on Social Security to replace their income in case of disability. That is true. So unfortunately, Social Security has a narrow and strict definition of disability, of which many do not qualify. You know, as we define Social Security, disability based on Social Security yesterday, to them, to Social Security, disability is you must have to, if you are sick, that sickness must lead to death, or you must have that sickness for 1 year. That is when Social Security will now know that you are disabled. And that's when you have Social Security disability. And of course, it's limited. But our people do not know all those. It's limited. So yesterday, we discussed a lot, much more about Social Security, how it affects you, how it affects your family. In fact, we are so vocal to say everything as it is. So additionally, it first to meet all needs. Social Security disability, if you rely on it, it will not meet all your needs. Because of what? The consideration, Social Security should be considered a secondary source. Personal disability insurance plans, whether group or individual policy, should be the primary source of income in the event of disability, not Social Security. That's why I said, if it's possible, if not the finance, the premium involved, if it's possible, everybody can put everything in insurance and get yourself free. If it's possible. And believe you me, some people do, some people who are rich, they do it. They have all those in place and they will just relax. Yes, but due to finance, we are restricted. So policy owners can manage premium costs by accepting a longer elimination waiting period before benefit begins. I think yesterday we discussed much about elimination waiting period. Who is here yesterday when we talk about waiting period? I said this review is much. You will be here seeing a lot of period. So I said, whenever you see any of them, write it down on a piece of paper. I mean, on a small note you have, so that when on the day, a day before the examination, you go through them, go through all the periods and be able to know what they are. The waiting period is always 5 months, and that 5 months you have to wait, which means if you are disabled, you have to be disabled for at least 5 months. You file a claim. Then the 6th month, that's when your claim, you start receiving benefits. So that's the waiting period. So the period of waiting is a period you are disabled and the claim have not started, you have not started getting your benefits. You file a claim, the claim will stay 5 months. The 6th month is when your first check of disability benefits comes in. So that period you said we are waiting before payment comes is what we called the waiting period or elimination period. Most times in the exam, you will see it. There's no doubt about that. So due to favorable tax treatment given to individuals found under disability income policy, benefits are income tax free. Of course, benefits are income tax free. Remember that you take this money from your check at work. Before they take the money, they have paid tax on it. So that's why it's income tax free. A plan provides only a percentage of person disability growth earnings. Policy typically cap between 60 to 30. We cannot go through all this. So, all right, long-term care, LTC. Remember, in life, on main life insurance, you have long-term care. This is one of the other things that people who are, if you have what it takes, it's good to have. Is seen is a rider when you have life insurance policy. If you have life insurance policies, long-term care is a rider. You can also write it as a single individual policy. So if you do not have it as long time, as a rider in your policy, you can also buy it as a single policy. So long-term care is in insurance, is also in health insurance. So long-term care insurance covers the cost of caring for individuals who lost the ability to perform daily tasks necessary for independent living. Of course, if you have it as a rider in life insurance, when you are not able to do 2 to 3 of activities of daily living, definitely that's when it comes in. Activities of daily living, when you cannot be able to take shower by yourself, cannot feed yourself, cannot toilet by yourself, cannot, either lie down or something like that. There are 5 of them. Activities of daily living. If you cannot be able to do 2 out of those 5 or 6 of them, then what happens? Their long-term care will set in. So it's good. And even some people who are caregivers, who have experienced caregiving or who have worked as a caregiver before, it is that sometimes you go to somebody's home to take care of him. You're not taking care of the person in the hospital, neither in nursing home or other facilities. You take care of the person at that person's home. Then what you see there is the exhibition of good retirement management. That's what you see. Anybody, any family, you go to their home to take care of the elderly one, you are seeing just the manifestation of somebody planning for a good retirement, of which we said your retirement should start from the first day you start job. That's when you start discussing about your retirement. Because definitely, whether you like it or not, all of us here must retire one day. Is the basic truth. So the question now becomes, what happens when I retire? Where will I be when I retire? Am I planning to go to nursing home, or am I planning to, if in case sickness or anything happens to me, Am I going to be at my home until I pass? That is the question that should come to everybody's mind. More especially for new people, the younger ones, those who are below 30 to 20, 25 to 30, who just started their first career, a job. They should start immediately to start thinking about their retirement. Yeah. They should not base on their retirement on Social Security because the government is going to disappoint you, or the 401k. Of course, by the analysis we did yesterday of Social Security, you see that Social Security funding can be depleted. Government is not funding Social Security. Who is funding Social Security? The employee, the employer, and the self-employed. They are the three people funding Social Security. And based on the technological development, things you have seen now, you see that the employee, which contributes almost 60% of the funding, are being depleted. Go to some of the grocery stores. You can no longer see cashier who's checking people out. No, it now reflects by self-check. Go to most of our companies, the job that individuals are doing are being done by machine. So if individuals are doing those jobs, as the employee, they'll be contributing to Social Security. Now, when those people are cut off, don't you see that funds on Social Security will reduce? Yes. And so you see that Social Security continue to exist is very, very questionable, except you don't want to tell yourself the truth. That is the basic truth. And of course, they know it. That's why you see the new policy they bring out. If a child is born today, they say that child should have $1,000. That's the new president. President, that was his new policy. Every child born should have a government funding starting from $1,000. And they made it that the parents should have access to the account. So the parents can pay into the account anytime they have money. What they're doing, they are trying to replace retirement benefit for our children, starting from the day they were born. And that is so wonderful, that's so good. Because reliant on Social Security is not going to work. Payments of Social Security, if 2 or 3 people are contributing, one person, they used to pay one person who retire. At the time, the ratio of people who are working is almost equivalent to people who are retired. Who is going to pay for Social Security? Government is not putting 1 cent to it. So these are the things you have to know. So for somebody who have long-term care, you are creating another way to take care of yourself when you cannot be able to do 2 or 3 of the activity of daily living. So the loss may be physical or cognitive, but it's always the result of organic cause. Therefore, long-term care insurance covers seniors, dementia, Alzheimer's disease, and Parkinson's disease, but not anxiety or depression, which are considered psychological conditions. So long-term care most often covers sometimes chronic, terminal, and chronic terminal disease, of course. So it's good to have, if you can, it's good to have. You can have it as a rider. If you have policy, find out from the person who wrote your policy whether you have long-term care. If you don't have long-term care, you can as well buy it. You can get it as a single policy. So dental insurance, of course, everybody here knows what dental insurance is. Now we're gonna jump it. Accident insurance is accident insurance provide a benefit when an insured is injured in an accident, whether on or off the job. Another issue I want everyone to know when we talk of on and off the job is this. Your group life insurance at your work, does it cover you on and off the job? Your group life insurance you have at your work, because most people are forward to say, if you talk to them about insurance, they say, I have my group life insurance in my job. Ask them, does it cover on and off the job? Of course, I don't think so. Of course, I do not think so. The reason why, one of the reasons that I'm convinced that it is not so, is that when you leave that job, you leave the group life, you are leaving the benefits. When you leave the job, all the benefits will vanish. You have to provide the benefit by yourself. Of course, through Cobra, you can convert that office, their company insurance to your own individual insurance. Then it's very, very expensive. Very, very expensive. I just did mine. It's very
Cobra is expensive.
It's very expensive. So ask them whether the insurance they have a job, does it cover on and off the job? That's one question they should answer, of which I know it does not. So accidental death and dismemberment ADA insurance is a common type of accident insurance. It is also offered as a standalone plan, part of a group plan, or as a rider added to other types of insurance. AD&D is one of the insurance that people can buy. It pays lump sum benefit in the event of accidental death or dismemberment insurance. Most of the people do not want to have it. Insurance company is afraid to give it to people. You know the reason? When anything happens, they pay the benefit twice. Twice or three times of the benefit. If the benefit is 500,000, if the person dies of that, they were going to pay the beneficiary twice. You know, the initial one was 500,000. They're going to pay either 1 million or 1.5 million. So most times, insurance companies find it difficult, and if they do, the premium is always as high as every other thing. So classes of health insurance, we have individual versus group. Of course, this is what is bringing us to our job. Individual versus group contract, private versus government insurance, limited risk versus comprehensive policies. So let's go to them. Let's first of all discuss individual versus group life insurance. Group contract. Of course, the one you have a job is group contract. Commercial insurance service organization issue individual health insurance. You can equally have individual health insurance. Me and my family will have individual health insurance now because I'm no longer working. So we have individual health insurance. You can have it. Although it's very, very high as far as cost is concerned compared to when you have it as in a group. So it's a personal contract between an insured and the company. Although companies have standard policies for the coverage they offer, most allow individuals to select various options. Of course, you select a various option that will determine how much you pay. During the enrollment period, you can adjust your choice. It determines how much they take from your paycheck. But again, what will help you, if you find out whether it's contributory, how many percentage your company is contributing, and you know how many percentage you're contributing, that will help you to be able to make a good choice. Because as you continue to make a good choice, the premium goes higher. But if your company, let's assume your company is contributing 80% out of that money, then you are contributing 20%. You see that what you'll be paying from your paycheck may not be much. But in the situation that company is contributing 50%, you are contributing 50%, you are going to pay much from your paycheck. So those are the things you have to check. Most of us, they give us say benefit, we just take it without checking out those. And indirectly, it will affect your pocket. So you enter into this business, it's going to make you to know how to close up all those gaps. There's so much gaps in our lives that we are doing things that we're not supposed to do. By their money is vanishing. And by the time we realize this when we retire, there's nothing in your pocket. Before anything, see a doctor, before you know it, he goes to nursing home. That's not how it's supposed to be. So our fight is to make sure in the community, some of those things that we do wrongly, we start to do them correctly. So one of the purpose why you are here today is not only to pass the exam, but also to teach people that, look, this is the right thing to do. Teach people, first of all, start from your family. Get yourself everything in order first, then begin to teach people. Forget the money you're going to make. The most important is the impact you make to people's financial understanding. They will understand the right thing to do. So here is this business an opportunity that will expose you to some things you do not know before. You may know them, but you take them for granted. But it's going to give you the benefit to understand that, look, this is very necessary. So group insurance differs from individual plan in terms of contract structure, cost and premium payment, and eligibility requirement. When you're going for group insurance, it's quite different from when you're going for individual insurance. The cost to start with differs. The cost on individual is high compared to cost in group. The cost is, of course, the premium, and eligibility requirement is another issue. If you go for group, they may not be, nobody will ask you, are you sick or not, to be able to find when you have much sickness before you come in. Nobody want to know that. If it's in group, nobody. But if it's individual, most such questions will come up when you are filling the form. So they are accessible to employers, trade and professional association, labor union, trade union, and other organization, of course, group contract. The contract is between the insurer and the group. Remember, when you have individual, the contract is between the insured and the insurance company. But when you have a group insurance, the contract is between the insurance company and the group. So now, if you have it at your work, the group is the employer. The group is the employer. So with standardized coverage option for individuals, premium depend on the group risk, which may be assessed using the group claim history known as experience rating, and used for large group or the risk in the level known as community rating. So I want everybody to know what experience rating and community rating. You may definitely see it in the exam. Experience rating and what? Community rating. Experience rating is used for large groups, while community rating is used for smaller group. So for experience rating in our jobs, in a group assurance, is a large group rating using the risk rating of much people to get what the premium will be. But in the community, it's a smaller group. So express rating is what? For larger group, and community rating is for smaller.
Rating is the word?
Rating.
Express rating is for the
experience rating is for large group, while community rating is for smaller group. In fact, that's just knowing that way, you see, you're going to pass it. So when you see it in the exam, you basically know what they're talking about.
Express is for large group. Express rating?
Yeah, experience rating is for large group, and community rating is for smaller group.
Is large group.
Yeah.
1 second, don't move yet. Large group. And community?
Community rating is for smaller group. That's group, smaller
Thank
group.
you.
Yeah.
Thank you.
This is how they determine the premium. The risk, normally in insurance, the risk determines the premium. When we did a risk rating, classification of risk, you can see those who have substandard pay more than those who are on a preferred level. I think people who follow us to do classification of risk classification, we understood that. So in the group rating, where you have a larger group, which is the experience rating, you see that the payment here may be small compared to community rating, where you have a smaller group. All right. So this is how they find out how much you're going to pay in your insurance, your group insurance. So additionally, group insurance must comply with supplemental state and federal regulations, such as the Consolidated Omnibus Budget Reconciliation Act, COBRA. This is one of the most important things that everybody should know. It helps me when I retire, and it will help you when you finally retire, because all of us here one day we get out from that job. So Consolidated Omnibus Budget Reconciliation Act, COBRA. What does COBRA do? Now that you are at work, you have group insurance, you have group health insurance, you have all those group things. When you get out from that job, COBRA, as an act, we do what? We provide you, the employee and your family, an extended duration of limited coverage following employment termination or following employment resignation. Normally, sometimes it's monthly or maybe 2 months. So within that period, you are given the opportunity to convert your group life insurance to an individual life insurance, or your group health insurance to individual health plan. So that's what COBRA does. COBRA gives you an extended, you and your family, an extended limited coverage following your resignation from their job or your termination from their job, of which during that period, 2 months or 3 months coverage, you are given the ability, the privilege to do what? Convert your group life insurance to an individual life insurance or group health insurance to an individual health insurance. So that's what Cobra does. I did utilize it. And if, for instance, you are converting from your group life insurance to an individual life insurance, you are not good, they're not going to ask you for insurability. They're not going to ask you anything. They're basically going to sign some papers and pay them your first initial premium.
And
Yeah,
they collect a bag of money.
Is that?
And they charge you a lot of money.
Yes, it's a pricey somehow. It's pricey. It's pricey. So corporate provides employees and their families with extended but duration limited coverage following employment resignation or termination due to a single monthly billing per group sponsored. Administrative charges of group policies are lower than those of individual policies. So one of the things that makes the policies when you have when you move from group to individual is because of the billing method. You know, administrative fee is one of the things that causes these premiums to be high. The administrative fees. When you are in a group, the administrative fees is less. When you are individual, the administrative fee is higher. So that's one of the things that makes it to be high. Of course, the same thing applies to the premium. You can see that when you are paying premium annually, you pay less. And when you're paying monthly, you pay more. Of course, everybody must know that. Even in your ordinary auto insurance, if you pay 6 months or 1 year, you see that you're paying less than when you're paying monthly. What's making it to be less? Because of that administrative charges. When you pay every 6 months or annually, the administrative charges you paid it once. But when you're paying monthly, any month you pay, there's administrative charges attached to that payment, to that premium. So even to your credit card and all those things. That's why the credit card company will always advise you to pay the smallest, they say, because they want to continue to charge you administrative charges. They continue to tell you, oh, the minimum you can pay every month is $40. You thought they're doing you good. They're not doing you good. They're not doing you good. They say, oh, this is the minimum you can pay every month. It's affordable. Oh, at least $40 every month. They are not doing you good. They are ripping you because any payment you make, there is always an administrative charges applied to it. So you continue to pay it. They want when you pay the minimum. The credit card company want when you pay that minimum they give you. Yes, that minimum. Even your mortgage, they want when you pay that minimum. Your auto loan, they want when you pay that minimum. It favors them. For instance, your mortgage, you pay that minimum maybe 2,000 every month. You thought it's good. Why not add 2,500? Why not add 2,300 every month? Where the addition goes directly to the principal. You are cutting off their leg. You are cutting off the interest they're going to make upon you. So those are things what we know. The auto insurance, yes, monthly is good, but if it's possible for you, pay 6 months. That will cut off those administrative charges. That's what increases the premium. Try it and at least try it, you see the benefit. So it's also in everything. The life insurance too, if you pay annually, you pay less than when you pay monthly. That is the basic truth for everything. That's why if you have a life insurance policy here, the agent who wrote the policy for you will be telling you, look, pay annually. Yes, that may be one of the reasons. And of course, when you pay annually, you build up cash value quick than when you pay monthly. So there's much advantages when you talk of paying annually or when you are paying monthly. It's also applied in health insurance. It's expensive because you pay monthly. That may be one of the reasons. So private versus government insurance. Of course, we know private insurance is the ones you can go there and buy by yourself. It's self-insured employers and association. So consumers purchase most of their forms of these forms of accident and health insurance through private insurance, including commercial insurance companies and service providers. So the health insurance is also provided through state and federal government, and those are the what we call social insurance. The government insurance and social insurance, Medicare, Medicaid, and Social Security are the three primary government health programs, and they are regarded as social insurance. Please, you should know that. For example, social insurance, they are government insurance. They are what? Medicaid, Medicare, and Social Security. Please, that's what you have to know. Of course, we have known by what we discussed in Social Security yesterday that Social Security previously is an insurance. It's not it's not as what we call it. Previously, it's called Old Age Survivors and Disability Insurance Program. That's what Social Security is. Old Age Survivors and Disability Insurance Program. That's what is Social Security. So it's not meant as people have much regards to it. People put it as center of their plan when they retire. That's not what it's supposed to be. It's an old age survival and disability insurance program. So the three government insurance are Medicare, Medicaid, and Social Security. Of course, we have done Social Security. We're going to see the remaining two, Medicare and Medicaid. So the federal government created Medicare to provide medical expense coverage for seniors and those with severe disability. Remember, in the Social Security, we are able to find out that in your paycheck, every time you pay you contribute 1.46% of your paycheck to Medicare. I hope everybody remembers that. 1.46% of your money goes to Medicare. And 6.2 goes to Social Security. Put two of them together is 7.65%. So at every time they pay you, you are contributing 7.65% to Medicare and Social Security. So I think everybody should know that. How much are we contributing? 7.65%. How much is your employer? The person that employ you is contributing 7.65%.
Right.
How much is self-employed contributing?
15.3%.
15.3%. So you can see. So if you are self-employed, you contribute more to Medicare and the Social Security. The employer who employed you contribute the same with you. They contribute 7.65%, while you, the employee, also contribute 7.65%. So the three government insurance or the social insurance is what? Medicare, Medicaid, and Social Security. We have already done Social Security. We're going to deal with Medicare and Medicaid. And the funding of Medicare is what I just said. Government do not fund Medicare. Medicare is funded by you. Government do not fund Social Security. Social Security is funded by you, the employee, the employer, and the self-employed. The same thing with Medicare. Medicaid is funded by the federal government and the state. However, it's being managed by the states.
Which one? Medicaid?
Medicare, yeah. It's funded by state and the federal government, but it's being managed by states.
Good.
So the federal government creates Medicare to provide medical expenses, coverage for seniors and those with severe disability. That's Medicare. Federal government created it. Who fund it? You, through your job. You fund Medicare. Medicaid is jointly funded by states and the federal government. That is the state and the federal government fund Medicare. They provide services to low-income individuals who meet financial eligibility requirements. The federal government define Medicaid program standard, and states administer this standard with improved state-specific variations. So federal government and state fund it, states manage it. Social Security provides disability insurance for those unable to be gainfully employed. Then, remember we said before you are fully insured, because Social Security is insurance, before you are fully insured with Social Security, you must work at least 10 years or 40 quarters. That's what we said yesterday. And that's what Brooke said. 10 years or 40 quarters, that's when you say you are fully employed. I mean, you are fully enrolled. It's an insurance. And what that intends to mean is that you will have a full benefit. A full benefit. If you file it, if you retire, you're going to have a full benefit. And the retirement age we agreed in Social Security is 67 years. If you take money below 67 years, you are taking less of your money. Their money be reduced by 30%. Which means you will collect 70%. For those who are smart enough, say, oh, I've started taking my Social Security when they have not reached 67 years, they are cheating themselves because they are being paid less. They are being paid less. They are being paid 70% of the money. 30% reduction. Then when you come to 67, you are getting your 100% of the money. When you get to 68 years, you are getting 100 plus 8%, which is 108%. Then 69 to 70, you are getting 124%. So if you start taking your Social Security early, you are indirectly cheating yourself. But if you start taking it from 70 years, you are getting extras, 24% extra. So why do you, if you are still healthy, if you are still healthy and you think you still have a long time to live in this world, why do you want to start getting your Social Security on time? You are losing bulk of money. 30% of the money, you are losing it. So in addition, the Affordable Care Act, of course, ACA, created state-based and state-administered health insurance exchange, which we call the marketplace. Most people go to marketplace to be able to get their health insurance, individual health insurance. So let's see comprehensive versus limited policies. We're not going to deal with all this. We're going to leave them. But comprehensive tend to be open peril. What we know what peril is, or something that causes loss. So comprehensive tend to be open peril policies. In other words, they cover broad range of losses and exclude only those expressly excluded by the policy. Like, let's get our mind a little bit from health insurance. Let's go to car insurance, auto insurance. In auto insurance, have comprehensive, you have limited liability. You see that limited liability does not cover all. It just covers the loss. It does not cover you. If you hit somebody, if you have limited liability insurance, if you hit somebody, your insurance will not know whether your car damaged or not. They will go and repair the person who you hit his car. They don't bother about you. But if you have comprehensive insurance, it covers both you and the person you hit his car. So you can see that comprehensive insurance in auto insurance is more expensive compared to limited policy or limited liability. That's a very good contrast, a very good example of that. So it's equally applying health insurance. You have comprehensive policy, it will tend to cover more. It covers a broad range of losses. And we only exclude only those expressly excluded by the policy, which means in the policy, there may be some exclusions. And those exclusions can be, in life insurance, we say suicide is an exclusion. So in health insurance, of course, there's some exclusions. There will be underlying disease that it may not cover. That's comprehensive. The limited policy, of course, what they cover is the loss they cover is limited, is very, very few. So, but however, their cost is not the same. The bigger one the comprehensive may cover all that you need. Limited insurance policy types. Limited benefit policy can be described as policies that provide benefit and express. The limited insurance policy type is not, we're just gonna go to the essentials. Is limited risk and special risk. This ones may not be necessary. All right, let's look at accident only, accidental death and dismemberment, AD&D insurance policy. It pays for the insured a lump sum benefit if an accident results in death or dismemberment. The policies require that an accident must be the sole cause of the loss or benefit to be paid. Policies often include restrictions or death benefit that the insured must die within 90 days of the accident. So those are the conditions put into it. The insured must die within 90 days of the accident. That's when AD&D benefit will take effect. So the loss cannot be due to insured being under the influence of alcohol or narcotics. So even if you have AD&D policy and the person go drink alcohol and died on the road, or take drug and die on the road, AD&D will not come in to cover it. There will be no benefit. So it must be a natural cause of accidents. But if the accident is due to influence of alcohol and narcotic, definitely no benefit will be paid. So let's look at the principal sum and the capital sum. We talked about it yesterday. Accident, most times, accident depends, benefit you get from accident depends on how severe the accident is. Dismemberment, when we talk about dismemberment, is when you lost your hand, your leg, your ear, your eye, all those are what we call dismemberment. Then the severity of the case depends on how much, whether you get the principal sum or whether you get the capital sum. Capital sum is when they pay you part of the money, 50% of it, and the principal sum is when all the amount was paid to you. So the principal sum under the terms of AD&D policy, the principal sum refers to the death benefit payable if one death results from an accident. The principal sum is the first amount of insurance purchase and represents the maximum amount the policy will pay. So while the capital sum is amount payable when the insured suffers accident resulting in permanent loss of hearing, speech, sight, or limb, the benefit specific amount and is typically expressed as percentage of the principal sum, e.g. 50%, but it varies according to the severity of the injury. So the capital sum is not total lump sum, it's not total money of the first amount of the policy, it's a percentage of the policy, of the percentage of the first amount will be paid to you. So if the loss is total, then you have to get the principal sum, which is 100% of the first amount. But if the loss is not total, if it's severe, you get at least 50%. So that 50% you get is what we call the capital sum. The principal sum is when you get the total first amount. So that's what it is. So let's look at this. Let's look at this one below here. There's a typical example. It said, let's assume that an individual has an AD&D policy that pays $50,000 for accidental loss of life and the same for the accidental loss of 2 limbs or the sight of both eyes. Therefore, 50%, which is 50,000, is the policy principal sum. How much policy amount that person have is 50%. I mean, $50,000. Now, the same policy pays for 25,000 for accidental loss of vision in one eye or dismemberment in one limb. Therefore, 25% is the capital sum. So that is just a description of difference between capital sum and principal sum. You should know that it's for exam 2. So look at the exam tip. It said, when answering exam question regarding accident insurance policies, assume that losses that result from complication are excluded. Losses that result from complications are excluded. Remember, there's a difference between accident and complication due to the accident. The complications are not given count of. They are not part of the loss. What causes the loss, which is the pere, is what they are talking about. The complication that comes due to the loss is not included. It's an exclusion. For instance, you know that if somebody has an accident, probably they cut one of the leg, you know, definitely there may be infection. And you know the infection can cause death. So the infection that comes as a complication of the loss is an exclusion in accident insurance policies. So what they are bothered about is the loss of leg, not the infection that comes thereof. The infection is the complication. So if a test question asks for a time frame with which an accident loss must occur, assume 90 days. Of course, from what we read above, we see that if somebody has an accident, if the accident kills the person, the loss must occur within 90 days. The standard percentage used for the capital sum on an exam is 50%.
Excuse me, you weren't clear. I didn't hear you clearly. When you said if a person have an accident, what?
Yeah, if you have an AD&D and you file a claim and they say the accident, because of the accident, this person dies, that person must die within 90 days of the accident, of the loss. You understand? So that's when they consider that what killed the person is the accident, not the complication. What they're trying to avoid is the exclusion from complication.
Yeah.
Yeah. So that's what they're trying. They don't want to pay anything on the complication. Of course, you know, when accident happen, when somebody has an accident, there is always a complication. So they are not covering the complication. The complications in the accident are excluded. What they're paying is the accident. They're not paying for the complication. So the standard percentage for the capital sum is what? 50%, and that of the principal sum is the first amount, the total of 100%. So some policy might award a capital sum for partial loss of a foot or hand. All right. This, sorry everyone, this is very boring. This chapter is very boring. So you may not find it very, very interesting. So specified dread disease. Always there are some policies that you can buy policies for some disease called dread disease. Dread disease are cancer and heart disease. They are dread disease. They have life insurance policy for them specifically. They have health insurance policy for them specifically. So you can buy policy for dread disease. So policy benefits are scheduled fixed dollar amount for specified priorities or medical procedures such as hospital confinement or chemotherapy. So people can specifically buy policy for heart disease and cancer. So critical illness, specified condition. Critical illness is always a rider. If you have a policy here, you may have critical illness rider. Yes. You may have critical illness rider or terminal illness rider or chronic illness rider. 3 of them are there as a policy rider and also long-term care rider. But they cannot give you long-term care rider and give you what? Chronic illness rider, no. So
you can't have the 2 riders.
No, cannot. So normally if you choose, they give you, I think it's free, they give you critical, terminal, and long-term care. They don't give you long-term care with chronic, no. So those riders are free. So this is one of the things you should know. Some people will write the policy, those free riders, they will not take it, they will not give it to you because they do not, they miss it. So this is one of the issues you have to find out from your policy, whether you have, what kind of rider you have. Whether it's something, if a rider that's individually sold, just like long-term care, you can buy it, sometimes cheap. So let's look at hospital indemnity. Indemnity, the word indemnity, you may be seeing much in the exam. You may see it even in anything insurance. The word indemnity is paying reimbursement. That's exactly what it means, paying back. When they try to indemnify you, they're trying to bring you back to your original position before you have the loss. That's what we call indemnification. Trying to bring you back to your original position before the loss occurs. So you may be hearing indemnity. It's reimbursement. It's paying you back because of the loss. That's what indemnity is. So hospital indemnity insurance provides steady income from the day an insured is confined to a hospital until the day they are discharged. While the insured is confined to a hospital, these policies pay a specified amount on a daily, weekly, or monthly basis directly to the insured, not the hospital. So when you have hospital indemnity insurance, they are paying you directly. Then they pay you, now you pay the hospital. So the hospital does not have anything to do with it. I think most people will like it. They pay the insurance pay you directly, now you pay the hospital. Some people don't want to deal with that shit. They say, go pay the hospital direct. So if you have hospital indemnity insurance, when you have the loss, they will pay you, then you pay the hospital. If you like it that way. So credit disability insurance plan protect the lender. If you see something, if anybody remember when we talk about credit insurance and increasing and decreasing, you see that we talk about the loan, taking of a loan. Credit insurance is the lender. Disability insurance plans protect the lender. Who is the lender? The person who borrow you money is the lender. Credit disability insurance. So as increasing in term insurance, they also protect the lender. If I borrow money from you, you come to borrow money from me, I say, I'm going to give you this 500,000, but however, I'm going to put insurance on this 500,000 in case if you cannot be able to pay. Then in credit disability, it will now be in case if you cannot be able to pay me that money due to disability. So, but in term life insurance, in case you cannot be able to pay me that money, if anything happens, you cannot be able to pay me that money. More especially if the person dies, the person cannot be able to pay you the money, the insurance company pay you the money. So, but in credit disability, I will borrow you that money and you be paying it to me. In case if you cannot be able to pay the money to me due to disability, then I'll go to the insurance company to collect the money. So that's what's credit disability insurance.
I don't understand it. Honestly, I'm sitting here listening.
Did you understand?
No.
Did you understand what our explanation on term life insurance? How many what's the three basic types of term life insurance?
Increase, decrease, and I think level.
What do we say about increase?
I don't even remember.
Huh?
With an increase.
Can anybody help? What do we say about increasing insurance? Increasing
For
term life?
mortgage.
No, decreasing is the mortgage. Decreasing is for the mortgage.
Decreasing is for the mortgage.
I was here on Thursday last week. Didn't you remember?
Decreasing is for the mortgage. Then what is increasing? What is it? Can anybody help us? I think that's the only way to get it to everybody's
I'm gonna be upstairs. Let me go talk to those guys over there.
So can anybody say something about increasing term life insurance?
The one connected to the index, that's
no, increasing term life insurance. It doesn't have anything to do with index.
Is it the age?
Huh?
The age?
No. We have, all right, we have how many type of insurance we have? We have two type of insurance. One is term life insurance, and the other one is what? Permanent or what? Whole life insurance. That's the two basic type of insurance we have. Now we go again to say the term life insurance has three policies attached to it, three types of policies attached to it. We say in the three policies we have decreasing term, increasing term, and level term. That's the three types of term life insurance. I mean, three types of term policies, term life insurance, the three types of policies that are attached to term life insurance. In the whole life of permanent life insurance, we have also three types of policies attached to them. But the three types of policies attached to term life insurance, which we said is increasing, decreasing, and level term. Now, I asked, what is increasing term? Can anybody remember what is increasing term? Because I want us to relate it to credit disability. Remember, in increasing term, we talk about loan. In increasing term life insurance, we talk about loan.
So, all right, is that the one you said it increased over time instead of staying fixed? I don't. That's it.
Is that the credit? Is it connected to credit life type of insurance?
Somehow.
Yeah, it's like they use it's used for debt and loan settlement.
Good. That's what I want to hear. It's used for loan settlement. Loan settlement.
Loan settlement.
For instance, if you have increasing term life insurance, it operates as if you are using to pay loan. For instance, if I borrow money, you come to me and say you want to borrow, want me to give you money. I give you, I say, all right, how much? You say 1 million. Yes, that 1 million, I give it to you. I say, oh, Mister, I'm going to give you that 1 million, but I'm not sure of how you're going to pay to me. You say, oh, of course, I'm working. I'm going to pay to you. We agree that you'll be paying me $1,000 every month. But to be sure to myself, I don't want to lose my money, that 1 million. In case if anything happened, you're going to be able to pay me that money. Then I will tell you that, look, I'm going to add a insurance. I want you to add insurance to this loan. A credit insurance. I want you to add it to this loan, or increasing. Add it to this loan. If you add it to this loan, that will protect me, the lender, from losing my money. If anything happens, you couldn't be able to pay. So if anything happened, you couldn't be able to pay, I will go to the insurance company and say, oh, this guy owes me money, and I know he put a policy in this money, and now he's no longer able to pay. Look at what he pays. Look at where he remains, what remains. You present your paper, the insurance company now start from where the guy stopped. Most often they pay you lump sum, but the difference in decreasing term is this. They're going to pay you based on the remainder, the money that remains. In that case, there is no beneficiary. The they have is that company, that person, the debtor, the creditor that you owe. Is used in payment of our mortgages. As you pay, it decreases. As you pay, it goes down. As you pay, it goes down until you pay it off. But the increasing, you can decide to take it in lump sum. But in decreasing, you have to pay the insurance company that covered the loan have to pay the money to the lender until what? It finishes. This is exactly what we are using to pay our mortgage. You remember, if you pay your mortgage this January, by February, if your mortgage is 500,000, it's going down to 580 something thousand or 590 something thousand. Maybe probably 1,000 will go up. So remember, when you're paying your mortgage, it's compounding. So the effect of putting extra $1 affects the principal, because the intent is to be able to bring down the principal while your mortgage is being paid. When the goes down, what happened? The interest thereof, which has a compounding effect, will equally start going down, because you are cutting off what will build up the interest for the lender. So that's why most often people will advise you, look, make sure you add, in fact, realtor will always tell you that. I'm a realtor, that's why normally I use real estate to give an example. A realtor will always tell you, say, look, add 200 extra to their mortgage payments. That 200 extra you're adding is going directly to the principal, cutting down the interest that is using compounded effect to build for you, which the lender is using to make money out of you. So because of that compounding effect, that is why you have a mortgage of 300,000, you end up paying 1 million plus before you pay off the home. But if you keep on cutting short the principal, what are you doing? You are cutting down the interest. And before you know it, the home, you can pay it out on time. So the increased disability insurance plan protect the lender. It does not protect you. It protects the lender. If because of disability, you could not be able to pay the debt, what happened? Because you have credit disability insurance, the insurance company will pay off the debt. So that's credit disability insurance. Most payments can be monthly as the insurance company would. However, it's always in the contract. So credit disability insurance is what protect the lender. If the borrowers cannot, what happened? The credit disability insurance company will pay off the lender, the money that remains. So this type of coverage is available through banks, finance companies, retailers, or other creditors to cover loans or time payment purchases. So these are the things, like this one, we should be able to have it on our heads. Because if you understand it, if you understand what you need to understand is whenever you see credit increasing, decreasing, you should understand all those. If you get it, definitely, you cannot miss it in the exam. For those who have taken this exam, probably they did not make it, they will tell you that these three things, you must see one. There's no two about it. You must see one. So the earlier we understand it collectively, the better it will be for everybody. So the lender or the creditor is both the policy owner and the beneficiary. See, if you have a credit disability, who is the beneficiary? Not your brother, not your sister, not your spouse. The beneficiary is the lender. He's the policy owner. And he is the beneficiary. And who pays the premium? You. You pay the premium. But the lender is the policy owner and the beneficiary. Of course, if you cannot be able to pay the debt due to disability, what happened? The lender, the policy owner, will go to the insurance company and collect the money. So the insured is the debtor who typically pays the premium. A creditor cannot purchase insurance on a debtor without permission. Once indebtedness is incurred, a certificate of insurance must be issued within 30 days. So,
I have a question, sir.
Oh, go ahead.
So if I finish paying the loan
Mm-hmm.
and I don't owe the person anymore,
Mm-hmm.
I can collect the benefit from the insurance company.
No.
Ah.
If you finish paying the loan, it's protecting you against if there is anything that can result from you not being able to pay. So the benefit goes to the lender. You are not the owner of the policy. You are not the policy owner, neither you are the beneficiary. No. You are only the premium payer. You only pay the premium. So this is a tax most companies, most banks put on when you come to borrow money from them. It's just for their own security. So that's why it benefits the lender, not you. So if you finish paying the money, good for them. Of course, they want to secure their money. They want to secure their money so that no matter what happens, their money must come back to them. And if you're a lender, if you don't have that freak, then you cannot make it because you have to first of all secure your money. So that's what banks does. That's why most times, when you go to borrow money from bank or from such all those institutions, you find out that what you be paying may be more, and the paying the loan, what you be paying be more. Because your payment covers both the insurance and everything. So the lender always not want his money to lose. He said whether you will collect the money if you pay. It's a good question. Of course, if we listen it on a layman's view, when you finish payment, you're supposed to collect you could first turn out to become the beneficiary to go and collect the money. But because the lender is the beneficiary and the policy owner, he is automatically there to get everything. You are only the premium payer. You'll be paying the money. And remember, you'll be paying the premium and you will equally be paying the person. You see, you paying the monthly payment to the person and you paying the insurance, which is you paying the insurance premium. So two of them added together is the amount you are paying you are paying every month for that. You see? So that's how they do those things to make sure that they don't lose their money. Every lender don't want to lose his money or her money. That's the truth. So there's always conditions that protect their money. They're after protecting their money. So can anybody remember what we said about blanket insurance? Anybody remember what we said about? I think we said blanket insurance yesterday.
I think that one is for like students or like a team, a group of people with no names. Like a group insurance for like a soccer team.
Of course. All right, you got it. So this insurance carrier uses blanket insurance. Is most often insurance given to some of our children who are in sports and schools. Of course, it's continuous. If anybody, from each stage to another stage, from the kindergarten to this, from middle school to high school. So most often every school have it for their basketball team, for their football team. It's a blanket insurance. It does not change. When this group goes out, another group will come in. So it's always there. If your son is playing basketball, their team must have blanket insurance. I think I experienced that. They called me when my son has injury. Somebody hit him on the face, and tears when they are playing basketball. They called me on that. So every basketball team in the school have it. So it's a policy that cover group or association members exposed to the same risk, but at different times. The circumstances remain constant, but the group's composition, that is the individual within the group, continually changes. That is exactly what we see in schools and churches. That's what they do. So let's not waste our time there. Short-term medical. Medical insurance may provide up to 90 days to coverage. That's short-term medical. Then they cannot be renewed. Short-term plans have always been scaled down version of major medical insurance policies. So let's just go out. All right, prescription drugs. Of course, we don't say much on prescription drug. We're gonna see it as Part D. Prescription drug is Part D in Medicare. That's where we're gonna look on it well. Prescription drugs. It's Part D in Medicare. You know, Medicare, we have Part A, Part B, Part D, and Part C and Part D. Part C is a combination of Part A and Part B. Then Part D is prescription drug. We're going to see it when we go to Medicare. Dental insurance. What do we need to know about dental insurance? Is because everyone knows what dental insurance is. There's no standard. All right, let's see standalone types of dental plans. Types of dental plan. Dental plan can be what? Divided into 3 categories: integrated, standalone, and combination plans. So most often, including me, we do not pay attention to certain things because they give us that big paper, say we sign. We don't care because if we look at the time that we're going to take for us to read those things, we don't have that time to sit down and begin to read those things. But honestly, I've seen one lady that took her time, sat down, begin to read all those papers line by line with her pen on her hand, where she asked questions. So that's exactly what all of us should be doing. But because we do not have time, we're always in a hurry. We want to go to the next appointment, so we don't have time. So they give us those paper we just sign. In fact, me, I sign and go my own way. So if you have a dental plan, there's categories, 3 categories you can jump into, either integrated, standalone, or combination. If you have a standalone plan, you may use with any provider, which means they have separate deductibles and benefit limits, even if offered as a part of an employer group benefit. That is a standalone. They have separate deductible and benefit limits and can be used for any provider. Then integrated plans are offered in conjunction with medical expense coverage. So they share the same provider network and deductible structure. Of course, that is integrated plan. It's a combination of medical expense and dental plan. Combination plan combines standalone and integrated. So the combination, you can see that combination plan is like comprehensive. You have much thing to cover. So, and of course, the pricing, the premium you're going to, on the combination plan may be higher because a combination of standalone and integrated plan. So all those things, if you're buying plan, we should be able to look at them. We just look at the cost. We just go our own way. We don't even care. Everybody, not everybody. So types of plan benefit: scheduled basic plan, non-scheduled comprehensive plan. So basic plan is just just like if you check your car, when you have comprehensive, you have a total bundle. You have a lot covered. When you have basic, which is limited, basic is limited. Now comprehensive is everything out together. So that's the type of plan benefits. Scheduled plan, that's a basic plan. Is offer benefits for specific services according to published schedule. They pay the actual cost of each listed service up to a stated maximum. Then the comprehensive or the non-scheduled plan embroiders most type of dental coverage. Of course, the best should be comprehensive plan, which is non-scheduled plan. It means that they cover everything. So we have to check out the best to do. Then we have levels of dental treatment, preventive services, basic services, major services. So it depends on what you want. And of course, the money depends on what you're going to pay, depends on what you have. Dental specialists. Of course, we're not going to go through all this. Oral surgery, we're not going to go all this. I'll take this was, even if you see it in the exam, you'll be able to know. So we can go ahead and do this. I'm trying to see whether we can just finish up this chapter so that we end at another chapter when we finish annuity. I told you this chapter is very boring. So for those who come new, this is a boring chapter. We are just struggling to make sure that everybody get it as much as we can. It looks boring. So let's match the dental specialty with the correct descriptions. Excuse me. Excuse me. All right. So let's match this. This is although we didn't go into explanation of all this, but we can still have a little idea of what they are and how they can, well, whether we can understand this more. So let's match it. The bridge or dentures, treatment of gum disease, service of children and adolescents, root canals, braces and retainers, tooth extraction, treat oral disease such as oral cancer. So if you guys don't want for us to do it, if you can waste our time, we can bypass it because we are doing life insurance. We're not doing all this.
Yeah, we can bypass it.
you can just bypass it and go our own way. All right. Limitations. We'll see authorization when we come to Medicare, HMO and all the rest. That's where we see authorization, the principles of risk certification or pre-certification. We cannot go to see service without that service being recertified. It applies in home health services. We go to see them. So limitation is although dental policy cover routine cleaning and visits, exam, X-ray protect fluoride treatment. I don't think we're gonna go all this since it doesn't. There's nothing.
How did you bypass it?
You say?
How did you bypass it?
Just click submit. You bypass it.
Yeah, I did, but it's not.
Yeah, click submit. Then you click continue. All right, I think we are done with this chapter. That's exactly what my aim is, because so we can do. Let's listen to this. This is just the last part of it. Then we do the questions and we go for the day. Let's just listen to this.
Congratulations on completing the Health and Accident Insurance chapter. Let's go over the key points to strengthen your understanding. First, health and accident insurance protects against two primary perils, accidents and sickness. Accidents are events caused by an external source that result in loss or harm, such as a fall, injury, or collision. Sickness refers to internal conditions like illnesses or diseases that develop over time or appear suddenly. The likelihood of experiencing either an accident or sickness is known as morbidity. Understanding these two perils is essential, as they form the foundation for most health and accident insurance policies and determine what types of coverage and benefits are available to policy owners. We explored 5 major loss categories, each representing a unique way health and accident insurance protects individuals. Medical expense insurance includes coverage for hospital stays, surgeries, doctor visits, and outpatient care. Medical expense insurance helps pay for the costs of treatment, so policyholders aren't overwhelmed by unexpected bills. Disability income is provided when an illness or injury prevents someone from working. Disability insurance offers regular payments to replace lost income, with payments made at least once a month to ensure that monthly bills can be paid. This helps individuals meet essential expenses during their recovery. Dental insurance focuses on preventive care like cleanings and exams, as well as treatments for accidents and restorative procedures such as fillings, root canals, and crowns. Accident insurance pays benefits when someone is injured in an accident, including coverage for accidental death and dismemberment. These policies offer financial support for sudden unforeseen events. Long-term care insurance covers the cost of assistance for individuals who can no longer perform activities of daily living independently due to chronic illness, disability, or cognitive conditions like Alzheimer's disease. By understanding these 5 categories, you'll be able to recognize how different insurance products work together to provide comprehensive protection against a wide range of health-related risks. Health insurance can be classified in several important ways, each influencing how coverage is structured and who receives it. One key classification is by contract type, whether the policy is issued to a group or an individual. Individual contracts are purchased directly by a person or family and are tailored to their specific needs, while group contracts are offered to members of a group such as employees of a company or members of an organization, with standardized coverage and typically lower premiums due to lower administrative costs for the insurer. Another classification is based on the provider. Private insurance is offered by commercial insurance companies, service organizations, or self-insured employers. In contrast, government insurance includes programs funded and administered by federal and state governments, such as Medicare for seniors, Medicaid for low-income individuals, and coverage available through the Affordable Care Act marketplace. Finally, health insurance can be distinguished by the scope of coverage. Comprehensive policies provide broad protection, covering a wide range of medical services and treatments, such as hospital stays, surgeries, and prescription drugs. These are the policies people are most familiar with, as they offer extensive benefits designed to meet a variety of healthcare needs. Limited policies, on the other hand, focus on specific risks or types of coverage, like accident-only insurance, cancer policies, or hospital indemnity plans, and are designed to fill gaps or address particular needs not covered by comprehensive plans. These policies include accident-only insurance, which provides benefits solely for injuries resulting from accidents, and specified disease policies that offer coverage for particular illnesses such as cancer or heart disease. Hospital indemnity plans pay a fixed daily or weekly benefit during a hospital stay, regardless of the actual medical expenses incurred. Credit disability insurance steps in to make loan payments if a borrower becomes disabled and cannot work, ensuring financial obligations are met during challenging times. Blanket insurance is used to cover groups exposed to the same risks, such as students on a field trip or passengers on a bus, even though the group's composition may change over time. Each of these limited policies is tailored to fill a unique need, providing targeted protection where broader policies may leave gaps, and helping individuals manage specific risks with greater confidence. You also learned about dental insurance. We discussed the differences between standalone plans, which operate independently, integrated plans that work alongside medical coverage, and combination plans that blend features of both. Benefits can be scheduled, offering set amounts for specific procedures, or non-scheduled, providing coverage based on usual and customary charges. We also highlighted dental specialties such as orthodontics for teeth alignment, endodontics for root canals, and prosthodontics for dentures and artificial devices. It is important to remember that illness is caused by internal factors within the body, while accidents result from external events. The type of coverage an individual receives depends on the specific policy, the provider, whether private or government, and the overall scope, which may be broad or limited. Understanding these distinctions helps individuals choose the right insurance and answer exam questions with confidence. As you prepare for your exam, keep these distinctions in mind. Your expertise will help future clients navigate health challenges and secure their financial well-being.
All right. So let's firstly go to the exam. Let's go to the exam and we'll do it. It's small, just how many? It's not maybe 7 or 8. Oh, it's 22. Am I sure this is the right one? Am I sure this is the right one? Come on. All right. Wow, 22. All right. So let's go to the exam. It's 22 questions. It's a lot. It's a lot. So chapter 14 equally is health insurance providers. All right. It's 22 questions. Remember how to answer these questions. Use elimination method. We have 4 options. In that 4 options, make sure you go through the options and eliminate 2. Try to consider 2. Within the 2, one of them will be the correct answer. It's good to, even if you want to guess, even if you don't know it, you want to guess between 2 that you are sure of. So in guessing between 2, you have very big chance of getting it correct than when you guess in between four options. So always use elimination method. It works for everybody. It will work for you. So this one said, what is required for limited benefit policies? What is required for limited benefit policies? What's required there? What's required for limited benefit policies? Anybody? What is required for limited benefit policies?
So I'm eliminating C and D between A and B. Notice of insured status. B.
Right. Any other person supporting him? Any other person supporting B?
I say B.
All right. So 2% B. All right. Yep. Not a notice to insure stating it is limited benefit policy. That's what's required for limited benefit policy. It's not minimum coverage amount. It's not medical examination of all insured. Of course, these two, C and D is totally out of it. C and D is totally out of it. The consideration should be between A and B. So that's correct. So this one says, what is experience rating used for in a group insurance? What's experience rating used for in a group insurance?
Let's try C. Okay.
Any other person supporting her?
The experience.
First of all, you have to know what is experience rating. Do you know what is experience rating?
Yeah.
Do you know what it's used for? I said it today.
Well, you blend.
The answer is a D.
Any other person?
I'm in for D too.
All right, two persons said D. So I said it today. What experience rating, and what's community rating? I said it.
The price. Huh?
Large groups and
Large
small
group. It's large group.
You don't need to. You don't need to go and begin to think of. Immediately, I said just what I want you to know in that particular place is what know that experience ratings for large group, community ratings for smaller group. That's two things you need to know. If you know it, then you can answer any question on it. Then why do people choose to purchase critical illness insurance coverage? Why do people choose to purchase it?
provide routine to replace less to provide lump sum upon journals.
Why do people choose to purchase it?
To replace lost income during illness.
B as in boy. Yeah.
It's B.
All right. To provide lump sum upon diagnosis of critical illness. When you have, let me explain this. When you have a rider in your life insurance policy, of course, they give you 3 free riders. And those riders are attached to your policy. Remember, riders is what beautifies your policy, what makes your policy more beneficial. And most of the riders, in fact, all policies are good. But again, it depends on what riders are there, what beautifies it. I normally use pizza as an example. Me and you went to pizza store to buy a pizza. We decided that we're going to buy veggie pizza. Then we entered that pizza. The standard price for that veggie pizza is $20. And I paid $20 to collect mine, but you come, you said, no, you don't want, you want the same pizza, but you don't want the one I collected. You want them to add pineapple. You want to add orange. You want to add vegetable. You want to add everything. So those things you are adding there is what beautify that pizza. And they are riders. When you add them, do they come free to you? No. You pay extra money to get those. So remember, me, I paid $20 to collect my pizza, and I walk away. You, because you want to beautify your pizza, you want to make it more nutritious to you, you add all those. You're not going to pay the same $20 I paid. No. Are you going to pay the same $20? No. You're going to pay more. You're going to pay more. So that's exactly what riders are in life insurance. So you can add more riders as you like to make it more beneficial to you. So critical illness rider in life insurance, sometimes they are given to you free, depending on the amount of the policy you buy, depending on the type of policy you buy. So people choose to purchase this because in case if they are diagnosed with critical illness, if you have a rider, you have a critical illness rider, it's not for income loss, no. It's only in case if you are diagnosed with any critical illness. If you have a rider for terminal illness, in case if you are diagnosed with terminal illness, you have a rider in chronic illness, in case if you are diagnosed with chronic illness. So that's when you have it. If you have them as a separate insurance, which is critical illness insurance, chronic illness insurance, terminal illness insurance, even dread disease insurance. Dread disease insurance for heart disease and cancer. If you have it, in case if you are diagnosed of dread disease insurance, that's when you go for it. If you go for it, they're not going to give you, normally, if they are as a rider, If you go, they will give you 90% of the first amount. But if you have a critical illness insurance coverage, you're going to get the lump sum of the money when you are diagnosed with such sickness. I hope everybody understood that. All right, so let's go. What is morbidity? We define morbidity several times. What is morbidity? What is morbidity?
I think it's A.
It's A.
All right. Two persons say A.
C.
Mobility is the probability or risk of getting or becoming disabled. It's not the probability of death. Mobility cannot be the probability of death. It's a collaboration of how people die and what sometimes can cause death. Most, probability of people dying is more in a more where there's more people than where there's less people. If I bring 1,000 people here, put them in a room, the probability of somebody dying there will be higher than when I bring 5 people keep in a room. So what is the mobility there? Mobility is that collaboration of bringing people, putting them in a room. So that gives the probability of death. So mobility is not the probability of death, it's the probability or risk of getting or ill or becoming disabled.
Okay. I keep mixing up with mortality.
Mortality. No.
Okay.
Mortality is the rate of that thing occurring.
Okay.
Yeah. Yeah, sometimes it gets confused with mortality. And we don't normally see mortality in life insurance. The question you see mostly will be on morbidity. And if you follow us in chapter 1, we treated chapter 1, you see that there's morbidity question, a lot of morbidity questions. So the correct answer is the probability of or risk of getting ill or becoming disabled. Morbidity specifically refers to the likelihood of illness or disability, not mortality or other health measures. All right. How is sickness defined in insurance terms? How is sickness defined in insurance terms? How is sickness defined in insurance terms?
I'll go for A.
Yeah, between A and D, but I don't know.
All right, three persons say all right. All right, an internal occurrence that becomes manifest. Of course, that's exactly what it is. Sickness cannot be defined as chronic condition, no. It can be acute. It can be condition requiring hospitalization, no. It's not only sickness, every sickness that you go to hospitalization. Somebody can be sick, fever, headache is sickness. In fact, sometimes poverty is sickness. When somebody is poor, it's sickness. It's not true. All right.
Very true, sir.
So what gaps in Medicare coverage does a Medigap policy primarily addresses? What gap in Medicare coverage does a Medigap? Medigap covers that thing that Medicare cannot. And that's where you see part C.
Part C. So I think
C.
C as in cat. Mm-hmm.
All right, two persons say C. So the cover gaps in Medicare. Oh, I don't know when I said it. So I didn't know when I said it at first. All right. So how does a point of service plan combine features of different insurance models? How does a point of service plan combine features of different insurance models? Service plan, how does it combine features of different insurance models?
The answer is between A and B, but I will put B.
Any other person supporting him?
A.
I'll say A.
All right, 2 persons say A. All right. So combination of features of HMO and PPOs. We're going to deal, in fact, we're going to deal is like providers. That is chapter 14. That is the next chapter we're going to do. How HMO and PPO, the difference between two of them. You see that all those things are just, you have one circle. I mean, yeah, let's assume one, how do I put it now? All right, you have a cup. You have a seed inside that cup. And you know that inside that cup, if you put one seed is okay for that cup to grow in that cup. One seed is just okay to take care of everything, every environment in that cup. Now, you decide to have that cup with that one seed. You decide to add another seed. That's exactly what we're going to see on HMO and PPO. What are different? Why can't HMO deal with what PPO can do? And if we have PPO, why can't PPO do what HMO can do? And what is this difference between the two? And is there any need for us to even to divide them to have HMO and to have PPO? Why can't one of them do it? And even at all, why must we not, if Part A and Part B take care of, why must Medicare not take care of them going into HMO and PPOs? We try to see whether we can answer those questions, whether the divisions we have on HMO and PPO, whether it's actually necessary. We're going to see it when you deal with chapter 14. All right, what is the basic principle behind how HMO plans manage healthcare delivery? What is the basic principle behind how HMO plans manage healthcare delivery?
D.
Another person?
Yeah.
D. D.
All right. So they provide coordinated care through a network of providers. HMO plan provide coordinated care through a network of providers, ensuring efficient and cost-effective coverage. We're going to find out whether it's true or not. So what is experience rating used for in a group insurance?
Is B. D again.
So another person?
Yeah, D.
Did you notice something that this question we answered it before?
Repeated.
Yeah, it's repeated.
All right, so when you go to your exam, it's the same thing. Sometimes you can answer one question 3 times. Please, do not change your answer if you're sure the answer is correct, because sometimes your mind will be telling you, oh, whether you made mistake on the first one. No. Remember, these questions are in question bank. As they roll in, whatever comes in, what you answer. So don't be surprised. You can answer one question more than 4 times. Whatever that comes is what you answer. Don't get freaked out. Oh, probably when I answer it wrong, that's why they give it back to me. No. So you see, as we answer this one twice, we will even answer it 3 times. So it will be in the exam. You can answer one question more than 4 times. Yes, you're not wrong. As far as you know that the answer you selected is correct, please keep it that way. You're not wrong. It's just a repetition. All right. What is required for limited benefit policies? What is required for limited benefit policies? What is required for limited benefit policies?
A. This is repeated too.
All right. So any other person?
A.
A.
All right. So this is another repetition. So please remember this in the exam. It's confused. It brings people to sometimes you question yourself whether do you know what you're doing at all. So it's always like that. So what is the key difference between individual and group health insurance? What is the difference between the two? Individual and group health insurance. I said a lot of things about individual. I even use myself as an example about individual and group health insurance. What's the key difference?
A.
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 2% say, of course, in individual, we require evidence of insurability Quite in a large group, which is group policy, use experience rating, of course. So what is the elimination period in disability insurance policy? What's the elimination period?
Waiting period. This one, even if I'm dreaming, I can. You've said it so many times.
All right. So any other person supporting her?
The period before.
D.
The waiting period.
So it's a waiting period before benefit begins, of course. Well, I like what you said. Even if you are sleeping, you wake up, you see it is a correct. So, which of the following is the characteristics of comprehensive health insurance policies? Characteristics of comprehensive health insurance policy. Remember, we distinguishes liability insurance and comprehensive. We use car insurance to differentiate the two. So, which of the following is the characteristics of a comprehensive health insurance policy?
B.
Oh, B. This
It's
is
B.
So it's B. It covers broad range of losses and services, of course. That's why it's called comprehensive. So how does a HDHP differ from traditional health insurance in its primary approaches? I know everybody know what HDHP means.
No.
It's high deductible health plan. High deductible health plan.
Oh, thank
That's why
you.
it's a C.
So C, yeah.
So if you don't understand what that HDHP is,
I know.
you'll be thinking, what is this? So it's high deductible health
It's
plan.
C.
All right.
Deductible health plan. I see.
So it provides lower premium with higher out-of-pocket costs. So what is the key features of a short-term medical insurance policy? Key features of short-term medical insurance policy. The key features.
D.
Another person?
D. Limited coverage for a short period.
Right. Self-assessed limited coverage from short periods.
Mm-hmm.
So what is the characteristics of scheduled dental plan? Dental plan, scheduled dental plan.
Wow, there you go. Bye, Mac. Thanks for the help. It's Lightning McQueen.
Scheduled for a little more.
Oh, that's so awesome. Yeah, the green people.
Is it B? Between B and A?
C.
I'm
No.
getting C or D.
Oh, okay. I'm lost then.
Me too.
So
Yeah,
which one?
D.
Which one should choose? D or B? Which was the choice?
Me, I think C.
Let's do C and C. I think.
Not let do C. Is that C you choose? Is that what you're gonna choose if you're in the hall now?
Yeah, I say C. Let's try C.
Let's try. No. You're not trying anything.
Hey.
Hey, well done.
So it defines benefits for specific services in a published schedule. That is the characteristics of dental plan. What is the main objective of a specified disease policy? Specified disease policy.
Main objective of a specific
For specific diseases.
B.
very benefit of specific diseases. Yeah, it looks like
B, because it has specifying it.
Yes, they have specified it. Yeah, sometimes you get the exam correct through that. Yeah. So what's the primary focus of a long-term care insurance? What's the primary focus? LTC. Long-term care is LTC. What's the primary focus?
D.
D as in dog. Yeah.
Oh.
D.
Yeah, covering the cost of care for individual with chronic condition. Of course, that's what it is. Long-term care is just for, it's not medical care.
Medical.
It's just for care of the person, his physical needs. So what's the main focus of hospital indemnity insurance policy? I hope everybody remember what hospital indemnity policy is.
Indemnity.
In hospital indemnity policy, they pay you, you pay your doctor. All right, let me use that word.
So D as in dog.
All right, any other person supporting her?
A.
Yeah, between A and D, but A
Someone
said
say
to
A, someone said D. Can somebody support any of them? So we go.
Maybe.
Huh?
To replace lost insurance.
lost income.
A.
Huh? D?
A.
Oh, all right, two persons say A.
B.
It to provide a fixed payment during hospital confinement.
I said D.
Confinement, provide a fixed payment.
Yeah, that's what they do. A fixed payment during hospital confinement. That's what they do. So what defines an accident in insurance terms? What defines an accident in insurance terms?
C.
C. C.
C.
C.
So of course, that's what it is. It's an unintended, unexpected. It's an action that you do not see it coming. It's unintended, unexpected. So, all right, I think that is it. How many? 17 over 20, 85%, of course, is good. So, we're gonna end here this today. In the evening, we will go through annuity. The next chapter we would have gone into will be health insurance providers. Health insurance provider, that's where we go into detail about HMO and PPO, Medicare Part A, Part D, Part C. That's what we're going to do on chapter 14. So chapter 15 is health, medical health chapter is another health chapter, which is medical expense insurance. Then chapter 16 is health, disability income insurance. So we're taking them one after the other. But tomorrow, this evening, we're going to do annuity. Hopefully we finish annuity this evening. Tomorrow morning, tomorrow is Wednesday, we're only going to have morning section. We don't have evening section. We're busy from evening. We have people coming into Dallas. People have started coming to Dallas for the event. So the event is on Thursday, Friday, Saturday. So our section will be only for this evening and tomorrow morning. All right, so we see
Time this evening.
Huh?
6 p.m.
6 p.m. this evening.
Thank you.
Yeah.
Thank you.
All right, see you guys in the evening. All right. Good day, everybody.
Yeah, you too. Thank you.